Folks, Bob Desmond here, and I want to wish everybody a very happy Easter and a reminder that we are going live tonight, 6 p.m. Eastern Standard Time, watching the futures action. So join us. I'll be sending out an invite about a half hour prior to us going live at around 5:30 Eastern Standard Time. You should receive that reminder and a link to the live stream. And normally I send out best stock charts for the new trading week to non-members. But this week what I wanted to do, because I think that what we're doing is we're reaching an inflection point in this market. So given that it's an Easter holiday, I wanted to share with you the week ahead commentary. And that'll give you a deep dive, a glimpse into how I am coaching members right now about how I am viewing this market, how we plan on trading it. And to cut things short, what we're looking to do is retain our current positions. However, what we plan on doing is adopting a more market neutral positions with new positions. Meaning, I want to begin to sell deep out of the money puts, deep out of the money calls. You could call it a strangle if you execute the same trade at the same time, a put and a call, same expiration date. But we're going to be looking to generate cash flow to take advantage of expensive options reverting to the mean, taking advantage of that inflated option value, scalping that profit or scalping the time decay, and just keeping a hoard of cash on the sidelines for opportunity that we could take advantage of if and when this market does begin to break and we see great buying opportunities, which I expect. So please enjoy the week ahead commentary. If you have any questions, shoot me an email. Join us tonight. You can ask me a question live on the live stream on YouTube. Until then, enjoy your Easter and have a great day. Be well. Okay, folks, welcome to the week ahead commentary. This week it's going to be a little bit different in terms of a strategic approach to this market. Before we get into it, I want to say, before I forget, happy Easter to everyone. And many blessings to your families, and hope everybody enjoys the weekend. So as you proceed into the new trading week, we had, of course, the market closed on Friday, but the economic data came out, and we saw a big beat, and good to see, a big beat on non-farm payrolls. The futures market surged on the news. It closed abbreviated. But net, we had the Dow up and the S&P up, both just shy of a half percentage point on the futures market. The NASDAQ futures and the Russell futures closed up just shy of a quarter percentage point. VIX, of course, dropped off. The biggest metric that I saw that would have concerned me, were I long, net long, were bond yields. And what had happened, I'm going to go to a chart of the bond yield in a moment. The 10-year Treasury bond yield spiked up to 1.714%. So that explains why the NASDAQ didn't outperform the larger cap cyclical names on Friday. I think that going into this new trading week, it all depends, as always, folks. This does not change. It depends upon what direction bond yields take. It appears as though of late we found somewhat of an equilibrium, whereas as long as bond yields don't surge higher, you're able to see a bid put under the tech stock names. The Qs broke out. Semis look strong. But if we see a big surge in yields, those rallies in tech stocks come under a lot of pressure. Now, what we're looking at here is a real great listogram of the debt. And we don't want to forget where we're at and the environment that we are in. You know, many people back when I was screaming about the resets on adjustable rate mortgages that were coming in 2007, back in 2005, and also in 2005, 2006, through 2007, I was screaming about why I was in such a hot economy, a strong economy, were the banks going to Congress looking for bankruptcy reform? What did they know? What did they see coming down the pike? And of course, when we look back in history, well, they knew well in advance what was going to happen when those rates, those teaser rates, reset from interest-only payments to the prevailing rate at the time. And of course, the housing market blew up. So what do we know that's out there? We knew this was out there back then. Nobody wanted to talk about it. But what do we know that's out there right here, right now? Well, we have debt, which has just gone parabolic in the past 12 months. And let's face it, going back to just prior to the COVID spike in debt, well, we could have said that this was a parabolic move already. This, to me, is a blow off top in the debt market. And how do we know? How do we know that we are seeing a blow off top? Well, yields are beginning to rise. What caused, and I shouldn't say beginning, they have begun to rise. And what was it back in 1999 that inevitably brought the dot-com bubble to an end? Well, it was two things. One, you had the year 2K capital expenditure come to an end. You also had rising interest rates, which ultimately popped the bubble. What do we have now? Rising interest rates. But back then, it was the Federal Reserve driving the ship, moving yields higher. Now it's the market. So why the doom and gloom? Why the concern about the jobs data on Friday coming out? Well, we know that 25% of all dollars in existence were printed within the last 12 months. And as per the Federal Reserve, we don't have inflation, but we know that not to be the case. We're seeing inflation in the housing market, stock market, energy market, wherever you want to take a look where prices have gone up, it's inflationary. Have we seen them to a dramatic extent in the consumer area where people are really feeling the pain? Probably not. Housing, you've certainly seen it. Insurance, you've certainly seen it. But when people go to the grocery store, that's where they really feel the pinch, and at the pump. And the pump has gone up. Now, what happens when you print all of these dollars, yet you have very little economic activity? Well, you may get some inflation, but not a ton because the velocity of money has not stirred the pot of demand, or demand has not stirred the pot of the velocity of money. However you want to take a look at it, it's like the chicken and the egg, which came first. All we know now is that we have a shortage, just like in the chip market, the semiconductor market, we have shortages, but we have demand. You have car manufacturing shutting down. So what happens when you have a bunch of consumers with $1,400 checks or more from the government, plus folks going back to work, now wanting to get their lives put back together? Well, there goes the velocity of money. And prices go up. Inflation then goes up. Fast forward to the end of the year, where it looks as though what we're going to have is a huge, huge tax increase. And many of those increases are targeted at capital gains. And they'll probably kick in 2022. What happens to stocks at the back half of 2021? Are you going to wait to pay capital gains in 2022? Or are you going to take advantage of capital gains in 2021? So these are the storm clouds that are out there on the horizon. So while, yes, Friday's jobs data was very, very optimistic, great to see people getting back to work. But the damage that's been done by the Federal Reserve and Congress by spending all of this money, printing all of these dollars, has sown the seeds for inflation once the economy reopens. And we're there. 10-year yield last week. We closed up on the week slightly. This is as of Thursday. This does not include Friday's price action. Now on Friday, we closed out the session at 1.714%. That's just shy of the highs of the week. Now, are bonds beaten up and yields pretty far extended? They've come a long, long way in a very short amount of time. Sure, I could buy that argument. But if we consolidate and then begin to creep up higher towards the 2% mark, buckle up. Here's a TLT weekly time frame. This 135 mark looks like good support. Bullish key reversal bar on the week, no breakout. Let's peek at the daily chart. Daily chart we broke out on Thursday. RSI looks strong. So it looks as though bonds are breaking out, at least on a daily time frame. Bullish price action on the weekly time frame. Let's go back to the weekly chart really quick. See where our indicators are. Volume was good. Stokes look good. So it looks as though we'll probably press up higher here on bonds, and we'll get a reprieve on yields. That should be bullish, at least in the short term, for equities. The tip market, weekly chart, closed down on the week last week. We still have a potential head and shoulders setup here. Daily chart, bullish reversal bar on Thursday, good volume. So again, it looks as though the tip market, the bond market for tips, is seeing the threat of potential inflation, and they are now beginning to consolidate. Don't forget the weekly chart with the head and shoulders setup. That remains a threat. The U.S. dollar. So I think we're very close to the end of this dollar rally. It was reflected in the rebound in the gold mining stocks last week. We flashed a very big topping tail. Does that mean it's the top? No, but it's just an indication that we're going to get a reprieve here, and it may just be a top for all we know. In the short term, maybe we'll pull back, put in a higher low. We don't know until we start closing down below key support levels whether or not we have seen a top in the U.S. dollar. But usually, when you get this type of topping action, like back here during the week of July the 29th, 2019, we pulled back. Was that the end? No, we rallied soon thereafter. So we don't want to call this a top yet. We want to remain humble. Expect a pullback, but do we close down below 92.50? That's our next support level. If we close down below it, well then, expect lower lows on the U.S. dollar. But we're not going to get all warm and fuzzy about the dollar being broken until we break 89.17 on the U.S. dollar. That's a long ways away. The VIX broke very critical support last week. So this leads me to believe that we're probably going to proceed higher on equities. COVID concerns are becoming more and more of a rearview mirror influence on the market, and that's a great thing. But despite the fact that we broke support on the VIX, I want to reinstitute the old adage that when the VIX is low, you got to go. When the VIX is high, you got to buy. Right now, we have a very, very low VIX. It's the lowest that we've seen since February of 2020. And frankly, back then, it was looking for a reason to break out. COVID was a reason. So have economic conditions changed all that much? I don't think so. We're far more in debt than what we were back in February of 2020. There are far more dollars in existence than there were in February of 2020. We have a president that plans on raising taxes dramatically in an economy where you have the Federal Reserve that feels it necessary to continue to buy back $120 billion worth of bonds each month. So how could he possibly think about raising taxes while the Federal Reserve is still trying to, quote unquote, revive the economy? It's like a Herbert Hoover moment. And the odd part is that the stock market historically has been a pricing mechanism going out a year, year and a half. Well, let's face it, 2022 is going to be here before you know it. So the 800-pound gorilla in the room is going to be, do you want to pay higher capital gains or lower? Well, if you want to pay lower, you sell in 2021. If you want to pay more, you sell in 2022. I think there's an obvious answer out there. So we'll keep an eye on this bill as it makes its way through Congress, see if there are any changes. The Dow transports continue to drive up higher. Very, very extended relative to the 2 standard deviation Bollinger Band. This is unsustainable. Can it go up a couple of more weeks? Sure. But we have now RSI at 77.14. I don't know how much juice we're supposed to squeeze out of this rock or blood from a stone. So, sure, we can head up higher, but history has shown us that around the 80 mark on RSI is usually the pinnacle. We're now at 77.14. Very light volume last week, even though it was an abbreviated week. This is very, very light volume. The Dow Jones Weekly chart up about a 0.25 percentage point on volume that would have been about, it's probably slightly below average. Let's take a look at the daily chart. The Dow's been very strong of late. Yeah, we're going up higher here. We're going to go up higher. The S&P 500 weekly chart up over a percentage point, new all-time highs. Volume, meh. Not great. IWM. This is a monthly chart. No new monthly high, no new monthly low. I still feel comfortable with being short the small caps. Nothing's really changed here from me from the logic of as to why we got short to begin with. The month of March, spinning top formation, sign of indecision, very close to a doji star. That implies that the trend might change. The trend has certainly been up. We're looking for that to change fairly soon to the downside. May not be this month. April's historically a strong month, so we'll have to bide our time. Weekly chart, bullish key reversal bar on the week. Now, this is going to be interesting. We have every reason in the world, given the technicals, to break out to new all-time highs next week or the week thereafter. But what if we put in a lower high, as the Stokes are doing, as the RSI is doing, and the RSI is putting in lower lows as well? And in fact, so is, or are the the Stokes. So this is going to be very interesting. The test is always at the top. Do we break out or do we fail and roll over? Daily chart. RSI is back above 50, bullish. Stokes rising, bullish. We closed above the 20-period moving average on a daily time frame, bullish. Volume on Thursday, not so bullish. Let's drill down to a 4-hour chart. So the argument here for a head and shoulders setup on a 4-hour time frame still exists, but I've seen this negated before, folks. So let's not hope that this follows through to the downside and go adding to short positions. Let's continue to use a rules-based approach of accumulation on weakness, or unless, of course, IWM becomes extremely overbought and unsustainable to the upside. The trip Qs, weekly chart, they want to break out. They did not break out. Very, 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 very close. Daily chart. Daily breakout with a continuation move higher on Thursday. Stokes looking good. They broke out. RSI broke out. Volume was very good. Technology, weekly time frame, did in fact break out last week. Remember, yields were pulling back off their highs. Volume is declining on a weekly sequential basis. And I mean, forget about Friday being closed. I mean, this is dismal volume. Even if Friday we were open. Daily chart, clean breakout. Higher lows for Stokes, RSI, horrible, horrible volume. The semis, they broke out. Volume was very good. Daily chart, they're already extended relative to the 2 and 3 standard deviation Bollinger Band. They can go higher. The banks, I think the banks are going higher. We have another week and a half before the banks begin reporting earnings. So I think we're going to get a continuation move up higher. And then as we begin to move into bank earnings season, we're going to toy around a little bit with selling some options on the banks as their implied volatility rises, meaning the value of the options of the banks should increase just prior to earnings because you have a lot of speculation that the banks are going to go one direction or the other. JP Morgan's going to miss, they're going to beat. And you have speculators out there taking both sides of that trade or one side of the trade. Either way, it's going to expand the implied volatility. Basically, implied volatility of an option is driven by supply and demand. So after they report earnings, you should see a decrease in the value of the implied volatility, even if the shares move one direction or the other. You simply have less demand for that option, and therein lies your profits. You take advantage of the decrease after you've sold the option, the decrease in value of the option because the implied volatility contracts, and that's the play. So more to come on that. Daily chart, we broke out. I had a one-to-one session with a very, very nice guy. His name is Amit, and we were talking about the banks. He was shorting the banks, and very, very intelligent person. Really good conversation. And I just brought to his attention the fact that we had broken out here, and beware that it looks as though we are going to go higher on the banks. Volume was very muted on Thursday. Biotechs, bullish Q reversal bar on the week. Stokes is still declining. They'll probably hook up. Volume was good. Now, daily time frame, be careful here. W formation, I think, is setting up. Expect a pullback here on LABU. Strong volume on Thursday, but not much in terms of price change. So you saw some selling in here. Let's go to a 5-minute chart. Yeah, in here. Not a ton of it. We did see a nice close. Consumer discretionaries broke out last week. Watch for a pullback and a retest of the 165 mark. We closed at 169. We gapped up higher on Thursday after breaking out on light volume. Energy, nice consolidation here. Given the price of oil, I think that we're probably going to move up higher on energy. Daily chart. Yeah, really nice move on Thursday. Energy looks like it's a buy. Volume could have been better. But when you take a look at oil, weekly chart, nice consolidation, bullish key reversal bar. We know the correlation between energy. This is the XLE again. Here's the correlation on a weekly time frame. Oil and energy trade together 96% of the time. So tick for tick for the most part. So oil looks as though it's going to move up higher. This is the value of knowing your correlations. So it appears as though the water's safe to go moving back into energy stocks. Gold, weekly chart. Now, gold had a huge comeback on the week. I mean, the first part of the week was just a nightmare. Is the selling done here? I don't know. Because we couldn't close positive. There just wasn't enough energy to push gold positive. Add to that, we put on nearly 1 million new jobs on Friday. Yields rose, and so did the U.S. dollar relative to the euro and yen. Those are the two primary currencies that trade against the dollar. Now, to be fair, gold did rally along with the U.S. dollar on the news. But at some point, one of them's got to give, either the dollar or gold. I'm hoping in the short term, to be honest, that it's gold. Because we did sell covered calls against the GDXJ trade, and we saw a sharp rebound in the share price. I'm glad we didn't sell calls against the NUGT. At least we still have a position in the gold miners. We're very close to the strike price on the GDXJ. We had the 47 strike. I went out to the 30th. I'm kind of kicking myself on that. Let's talk about it a bit. GDXJ. Let's finish off the dollar daily chart. Nice W formation potential here. Volume declined on Thursday. RSI on the verge of, it has broken out. Stokes hooking up. Hopefully we get another pullback here, and along with the GDXJ, let's go to a GDXJ. Weekly chart, very powerful week. A bullish key reversal bar on the GDXJ. Now, I did look into rolling out of the 47 strike price covered calls going out to the 30th of April. The problem is way too much time value still in those options to roll out and up. Meaning, I would like to put a few percentage points if I have to go out another 30 days beyond the 30th to roll out and up. Right now, to roll out and up without having to have money come out of my pocket, I can only get a couple of dollars to the upside and have to sit 60 days again with only a few dollars of potential upside here. So we'll be managing this. Hopefully we get a pullback and a little bit of time decay. That way it becomes far more palatable to roll out and up on those options. But there are other strategies to employ. I don't want to talk about them all here, so that we can maintain our current position on the GDXJ. If they go in the money, we can always sell 47 strikes. It's a little bit risky. And when I say sell 47 strikes, that means puts. But then the question's got to be asked, are we getting a little bit too heavy in that trade to the long side? So we need to watch our risk as well. So right now I'm hoping for the shares to trade a bit sideways. Let some of the implied volatility and time decay occur and pull back in those options. Then we could roll out of them, because this chart looks rock solid. Daily chart. Beautiful hook up here. Nice 2-day rally. Hopefully we get another pullback to retest this support level. Volume was very good. NUGT, this is a daily chart. We have a higher low. We broke out above one resistance level. We're just shy of another one. If we close above 57.50, it's game on for NUGT and the rest of the gold miners. Very powerful chart here. Gold money, weekly chart, looks very, very good. Bullish reversal bar on the week. Higher lows on Stokes. I think we break out to move up higher. Daily chart. Higher lows on Stokes. Yeah, I think we look really good here. So I'd be fine if anybody wanted to put on a long trade. We closed above that $2.50 mark. That's support. SILJ. I mean, this is one of my favorite charts right now. Bullish key reversal bar on the week. Rock solid. Note how we've been consolidating here. I'd like these Stokes to begin to hook up, to begin to gain momentum. I think we should do that fairly soon. Daily chart. Very nice. We bounced off the lower band of support. Actually, we broke it, then recaptured. Continuation move up higher on Thursday. So SILJ looking rock solid. Silver, a rough week, but man, what did? We rallied back to close above 42.50. What didn't we do? We didn't close positive. Same thing as with gold. You know, yeah, it was a great week, meaning that we rallied back off the lows, but we couldn't close positive. That bothers me. It still tells me that there are slightly more bears out there than bulls. Very light volume on the week, which is good. Daily chart, we closed right at resistance, so beware here. Cal-Maine Foods, a rough week, a very rough week. They reported earnings. Their input costs, especially with soybeans, hurt their bottom line, but sales increased. I'm still bullish on it longer term. We'll be looking to add more to this position, but I think we're probably going to get a better opportunity at lower prices. Daily chart, nice bullish reversal bar, maybe not lower prices. Maybe we're going to hold this 38.50 mark. No great rush to go adding more right here, right now. Let's see what happens. Volume rose on Thursday. Rocket Mortgage got rocked in the final minutes of trade on Friday. We sold puts into that weakness at the 22 strike price. And it was a fairly significant size position. And you only want to sell puts in any size that you would be comfortable with outright buying the common stock. So if I have 1,000 shares of Rocket Mortgage put to me by expiration at $22 per share minus the premium paid, which is about $1.38 per contract, I'm good because my basis cost is at $20.62. That would bring us down to this support level here where we have buyers of like mind. So if they're put to me, they're put to me. It's a great company. Yet I don't want to pay up. I didn't want to pay up for the shares because every time the darn thing rallies, it gets sold into. So all I wanted to do was discount my risk. So Rocket Mortgage, a rough day on Thursday and a rough week, but the trend remains up. Intercontinental Exchange, I should have added more. On Thursday, I did not because we did break out new weekly, week-over-week high. If we do not skyrocket higher here, then I'll be looking to add more to the ICE position. Daily chart, beautiful day on Thursday. Beautiful day. Ideally, we retrace down to 113. These Stokes continue to move up higher, and then we add more to our position. Quite bullish. Okay, let's talk now about FCN. And this is going to be a part of our strategy moving forward. We did 2 options trades last week, actually 3. One was the covered call trade on the GDXJ. The other was the naked put option on Rocket Mortgage. And the other, FTI Consulting. Now, these are 3 very, very different trades. One, the covered call trade on GDXJ was a hedge. And now we have to manage that hedge because we had such a sharp rebound. 2, Rocket Mortgage. Did I mind owning Rocket Mortgage? Or do I mind owning Rocket Mortgage at a net basis cost of $60 and 68 cents, something like that? No, I don't. I'll be glad to take those shares. So that's why I didn't use a probability tool on the Rocket Mortgage trade, but I did very much so on FCN, and I want to talk about that a little bit. First, let's talk about the whys. Why did this become the trade that I decided to make? Well, what we're looking at here, let's go to the daily chart. Well, before we go to the daily chart, let's do this. We have historical support on a weekly time frame at 144.10. Volume last week was slightly below average. If we were open on Friday, it probably would have been an average week, if not slightly above. So a good week last week. Daily chart. Now here's what attracted me to FCN. RSI was at that time like 85.6. It closed out the day on Thursday at 86.51. So we're nearing unsustainable levels. Can it move higher? Sure. But remember, we have resistance at 144 per share. Now let's talk a little bit about how we decided to open up these strike prices. We opened up a strangle, which is the sale of 1 put and 1 call at out-of-the-money strike prices at the same expiration date. I chose the May 21st options because studies have shown that once you get to the 45-day period, between 45 days and 21 days, that's where you get a large amount of time decay. So we're really going to want to siphon that off. I have very little expectations that we'll be carrying this through to expiration on May the 21st. So why do we choose these strike prices? Well, this is a very, very strong stock, right? So we don't want to underestimate the ability of the stock to move up higher. It probably will. So I wanted to choose a strike price that was deep out of the money with very, very little probability of having it called away from us or having to roll out of that position into a different time frame. So many options traders say, you know what, go with the 1 standard deviation. That's their wheelhouse. Some go with 2 standard deviations. Those are for traders with big money, and they can go way, way out on the risk curve and take very, very little risk because they have so much money. They're just printing capital with very little risk. But you always want to pay attention to the fact that markets rarely crash up, but can frequently crash down. So the most concerning leg of this trade to me is the put trade. So as we begin to see a 35 to a 50% profit on that leg, I am not going to let it ride. I'm going to close it out. And then as we appear to approach 90 or above on RSI, depending upon how close we are to the 160 mark and how much topping action that we see on the stock, I may look to add either to buy put options, or if we're still keeping that current put leg option open, I may look to buy some puts to take advantage of what I believe to be an unsustainable uptrend. Remember, we closed out Friday at 86 on RSI. So what this chart is telling us is that we have a probability. Let's go back to the one standard deviation. I went beyond the one standard deviation to about 1.5. Let's go to a 2, maybe about 1 1/3 standard deviations beyond where we closed on Friday. That's just to give us a little bit of protection, a little bit more protection. Now, keep in mind what can influence these probabilities are historical volatility. If you see implied volatility rise, well, the probability of us trading at or above the money or in the money rises. So here's your 60-day. See how the probabilities change here? 90-day, and then your 180-day. So keep your positions small here. And again, the game plan here is not to hold this position to expiration. Ideally, by 21 days from expiration, I want to be out of this trade. Once we see a 35 to 50% profit, we want out. So if you have any questions on these, use the Slack forum. I'll set up a channel for options trade. But the goal again here, folks, is to generate cash flow on unsustainable positions. And once we begin to see FCN begin to stall out and flash topping action, we're going to close out the put side. I'm not going to sell marked calls. I'll probably just buy puts to have more defined risk rather than undefined risk. Selling a naked call is undefined risk. Buying a put serves the same purpose. The however is you have time decay that works against you. However, it's defined risk. All right, let's talk a bit about trades we're looking to put on this coming week. We know that oil is going to move up higher. I thought about Franklin when I brought this chart up, and it's OPTT, Ocean Power Technologies. It's had a nice correction here. We have a nice W formation, higher low. Stokes is still declining. But if we begin to break out, it'll drag these Stokes back up. Last week's price action was good, not great. We did close off the highs of the week. Volume was not wonderful. Daily chart, we have a W formation forming, a higher low, but we flashed an outside reversal bar on Thursday. So this is just a watch. No reason to go opening a position right here, right now, but I like to set up if we begin to see strength in OPTT, and if you see strength in oil, you'll probably get strength in OPTT. The next watch position up for this coming week is Bug. This is brought to us by one of our other members. I can't take credit for it. I've just been tracking it. And Bug last week had a really nice reversal week. I'd like to see these Stokes flatten out a little bit. I think they will. Nice consolidation here. How's volume? Volume was a bit meh, but that's okay. It's consolidating. Daily chart. We broke out on a daily time frame. RSI validated. Volume was horrible. Expect to pull back and retest. So cybersecurity has been beaten up. I think it's time to step in because there are very, very few guarantees in life. And one of those guarantees is that there will be another cyber attack, probably much bigger than what we've ever seen before. So Bug looking really good. DR Horton, this is a little bit long in the tooth. This is a momentum trade. If we do it, it's going to be a trailing stop or perhaps a deep out of the money put. Not quite sure, but either way, we're going to stay very, very small because the daily chart looks good. The weekly chart looks really good, but we're getting long in the tooth here. And volume is dropping off. So I'm not entirely in love with this stock, but it is best of breed. You could also take a look at the Builder ETF, BLDR. That's a bit extended on a weekly time frame as well. Daily chart poised for breakout. So there's more room to the upside, but we're at that point where we're beginning to squeeze blood from a stone. So we're looking for at least one last move up higher here. Scalp a profit, move to the sideline. But watch yields, folks. If yields continue to press up higher, there's going to be a problem with the builders. Avery Dennison, really like this setup here. Weekly time frame first. We broke out last week. Volume is a bit light. Stokes look good. Daily chart. We broke out on a daily time frame. Watch for a pullback and a retest, or we could just shoot up higher. If we shoot up higher, we're not going to chase it. But we're at a buy point right now on AVY. Volume was very, very good on Thursday. This one was brought to my attention from a mate who I did a coaching session with on Thursday, and I really liked the setup. Now, the weekly chart, we flashed a bullish reversal bar. The only real negative I have here for the chart is that volume was very poor, despite the abbreviated week. It was very poor. But I think we are going to see a continuation move up higher here. We have broken out on the weekly time frame, daily chart. Here's a daily breakout in RSI, daily breakout on price, Stokes moving up higher. There's nothing not to like here. I mean, this is about as good as it gets. Volume was a little bit light, but I think we're pressing up higher here on looking very, very good. Now, you may be asking, are you thinking about selling puts on semiconductor? No. That might change, but the reason why I'm not looking to sell puts here is because your implied volatility is very weak relative to historical volatility. So if we went out, let's use 30 days. Historical volatility on the put side is around 44. Normal is at nearly 69. So options are fairly cheap right now going out on the weeklies and on the monthlies. Then it gets a little bit more expensive on the 60-day time frame. But this is a time to look to buy options because implied volatility is weak. But if we see a quick sell-off and an expansion in implied volatility, then I might look to sell puts. That might happen on a retest of the breakout point. But you really want to keep an eye on your implied volatility to see whether or not the options are, as I call them, fat, meaning there's a lot of implied volatility because there is a reversion to the mean, meaning if the average implied volatility is at around 69, then you want to be a call or a put buyer. To be a put or call seller, there's not enough meat on the bone because you want to see that reversion to the mean. Again, the average is around 69. I didn't explain this properly. At current, if we sold a put, implied volatility on a 30-day is around 44. We like to see it at around 80 because we know that the average is at around 70. So we get a reversion to that number and we scalp the inflation on the implied volatility. What drives implied volatility? Supply and demand of that individual option. So apparently at current, in the very short term anyway, there's not much demand for puts or calls on semiconductor. However, when you go out 60 to 150 days, there is demand for both calls and puts in green. So enough of this. Everybody have a really pleasurable Easter and enjoy the remainder of your weekend. I'll talk to you soon. And don't forget, if you have a question on options, go to the Slack channel, leave a comment there, and I'll get back to you. Be well.